Good afternoon, Angus. How are you today?
Hi, Patrick. Yeah, good, thanks. Can you hear me okay?
Yes, I can hear you fine. Can you hear me?
You could,
all good?
you could perhaps be a little bit closer to the microphone.
Okay. All good. We're ready to go.
Okay.
Good afternoon, everybody, and welcome to the Thursday member webcast. I'm Patrick Ganley, along with Angus Geddes, and we look forward to having a good chat with you today. But before we get started, we just need to cover off, it will be Angus and I on the presentation today, and we just need to cover off on some housekeeping items that all the information you're presented with today or any of the recommendations are strictly for general advice purposes, and if you're going to act on any of the information or take any of the recommendations we make, please consult with a financial advisor before doing so, and please be reminded that past performance is no indicator of future performance or returns. Comments and questions, you will have the opportunity during the presentation to ask any questions, which will filter through to us, and we will endeavor to answer as many questions as we possibly can. And you can see by the orange arrow here where you can complete your questions as they come up. If you can't hear the presentation or the presenters, please feel free to give us a call in the office on 1-300-88-1177, and we'll endeavor to help you get that sorted out so you can listen to the presentation. Okay, we're going to start now with the market outlook. The bond market rallied earlier this week after Fed officials delivered some peak rates potentially being reached, Angus, and I think this is a very interesting chart, and I thought it would give us an opportunity to talk about this, and I'll pass it over to you now.
Look, I think, Pat, you know, without question, really, the bond market has been, one of the primary drivers of what's going on in the stock market, really, for the last couple of weeks. And part of that is due to the fact that we've seen the long end of that yield curve really spike in recent weeks up to 5% or close to 5% on the 10-year Treasury bond. And I think really what's been driving it is the fact that we just had so much new supply of bonds, and the market's trying to work out how to clear what the clearing price is for all that additional supply that's coming into the market. But this week, it was encouraging. We saw the bond yields actually react quite positively. We've seen quite a decent rally this week. Yields have backed away 30, 40 basis points away from those peaks that we saw last week. Part of that might be due to the ongoing trouble in Gaza with Israel, the safe haven trade. We saw a bit of strength coming into the US dollar, but also possibly maybe the markets are beginning to say, well, the US 10-year Treasury is now moving up into a new trading range, and it's just trying to find where that ceiling and where that floor is. And I've written quite a bit about that in recent weeks. I think that 4.5, 4.4 is the new floor for the yield on the US Treasury. And for now, I think this surge, we're in sort of correction mode. Yields are coming off. I think the 4.8, 4.9, 5% level is going to be a near-term ceiling. This doesn't mean to say that, I think I'd be rushing back into bonds. I think, bonds are going to be in a secular bear market for some time. But near-term, we might see a bit of consolidation and see the dust settle. It has been rather tumultuous in terms of the volatility that's been going on. And that's put a floor under stocks as well. We saw the S&P 500 bounce off that key 4,200 level last week. So, all in all, for now, I think we might see risk on for at least the next few weeks anyway. I suppose all eyes are going to be on, focused on what's happening in Gaza.
So if the medium-term highs are in for the yield curve right now, where do you think this will take the stock market? Will the market take a positive lead from this?
I think the stock market has taken a positive lead, and if we could have that next slide, which is of the S&P 500, we'll see the index bounce, pretty convincingly off 4,200, and a lot of that was to do with the fact that bond yields have come down. It's been quite encouraging to see the indices find a floor and reassert to the top side despite the geopolitical risks in the Middle East. And so, I think, look, we've had this decent correction that played out through September and into October. The stock market typically bottoms in October, and depending on the outcome of the earnings season, which gets underway tomorrow, major banks all set to report their earnings. If we get a positive, a positive glows coming through from the earnings season, then I think, provided those bond yields remain well behaved, we could see a rally into November. But the caveat is the bond yields have got to settle down and stabilise. Secondly, what's also helped sentiment this week is some of the rhetoric out of the Federal Reserve. They look like they might be done now on the rate hike front. The long end of the curve has done a lot of the heavy lifting for the Fed, and whilst I don't think they're close to cutting anytime soon, it may well mean that the Fed's actually done on any further rate hikes, and we've got that crucial bit of inflation data, the CPI print, due out tomorrow, so that will provide more clues. But I think in terms of near-term direction for the markets, technically, it's looking like we can rally, but a lot of it's going to come down to the reporting season and what the outlook statements are for those S&P 500 companies.
Do you think we could see the 4,600 tested anytime soon, or do you think we're still going to stay relatively where we're at the moment?
I think we're range bound, and I don't think the S&P 500 takes out 4,600 anytime soon. But equally, 4,200 is a vigorous support level which will be defended aggressively by the market, I think. So I think we're in a range, and we're really looking for, I guess, some direction in terms of how the reporting season's going. Bond yields are sort of settling down, but we also kind of need to know which way the Middle East situation is going to go. Given that Israel getting ready to go in there, is that situation going to spiral out of control, and is it going to escalate, or is it going to be quite well contained in terms of that conflict? And we just don't know the answers to those questions yet.
So I thought we'd then just touch on the NASDAQ here for a second.
Yeah.
It seems to be facing an important technical test this week. What are you thinking with this chart, Ernest?
Yeah, so look, for now, the NASDAQ 100 didn't really get close to my target of 13,200. And as we can see on this chart, the uptrend from those December lows of last year remains intact in terms of that primary uptrend. There has been some resistance, and we've seen some lower highs since July, but that resistance level is now being tested as well. So look, a breakout above resistance would probably mark a resumption of upward momentum in the NASDAQ. And I think a lot of that is going to come down to two factors: declining bond yields, which we have seen bond yields stabilize, which is a tick, but also the reporting season. And the reporting season is going to be key. Now, the market has put quite big expectations on those mega cap tech stocks, and they do have a lot to deliver. The valuations have recalibrated a lot higher, so the bar of expectation is quite high. There's quite a lot to live up to on that front for some of these tech stocks. So yeah, I think, look, the next few weeks, it's all going to be about reporting season, and whether we continue to see those bond yields settle down into a new range.
Then we've got the longer term U.S. fiscal situation seems to be deteriorating. And I thought this was quite an interesting slide that you put together yesterday for one of your presentations.
Yeah, so I think I've been writing a bit about this week. I think it's really topical, and I think it's going to come to the foreground in terms of the markets. The markets are not really focused on it at the moment, but I think this is increasingly going to suck up a lot of oxygen on Wall Street, and it's going to become, a major point of focus for the markets, and that is the ballooning US debt, their fiscal spending, which is going through the roof, and the fact that interest rates have gone up. And for every bond that the Federal Reserve retires and replaces with a new bond, the cost of servicing that bond, or the cost of servicing the debt, is going up through the roof. And Paul Tudor Jones talked about this week in an interview on CNBC, and he made the relevant point. The US government spending on servicing the national debt will soon pass the entire military budget spending on the US military sometime next year. I mean, that is an amazing event, really, and statistic. And it just says that, that 33 trillion, they're rolling the debt over at sort of 4% and 5%. That's 1.5 trillion plus 1.6, 1.7 trillion per annum that the US government is just paying in terms of interest. And I think the debt to GDP is now at 121%. It's high, and it's getting to a point where not only is the bond market beginning to wake up to this, which is why yields are rising, but I think we're going to start to see some real pressure on the US dollar at some point. We've already had one credit downgrade this year on the US credit rating. There was a downgrade earlier this year. We're going to start to see more of those types of events, and I think that the problem is there's no political will in the US at the moment to rein in fiscal spending. You haven't really got either political party over there making a stand on it. So, it's just going to continue. Spending will continue until markets, until there's a reaction and there's a political will to do something about it. So, the IMF came out and said that, out of every country in the world, the US is really beginning to stand out as a major threat. So, what this chart tells us, this is the US dollar index between 1970 and 1980. Now, you'll recall, Pat, that back in the 70s, interest rates in the US went up. Inflation was high. We had a couple of oil price shocks. Bonds were a terrible place to be, much like they are at the moment in the current cycle. And, we had fiscal deficits and, big government spending and huge budget deficits due to the Vietnam War. Arguably there's some parallels with what's happening in the 70s. And I thought this chart was quite interesting because the US dollar went down, and, the US dollar's been going up. It's been strong for the last 2 years because of those rising interest rate differentials with the rest of the world. They've been blowing out. And so it's made the US dollar highly attractive to capital flows. But I think there's a problem with that, and there's a stumbling block coming. And it's the deterioration of the US fiscal situation. I think it's only going to get worse. And
so you're taking a bit of a bearish view on the US dollar at this time?
Yes, I am. And we had the Global Contrarian Fund AGM yesterday, and I made the point that one of our biggest macro calls for the next 12 months is that the US dollar has another leg down in a growing secular bear market. And, we've talked about that today on the podcast, on the webinar. I think it's, big spending, big US government spending, fiscal deficits, never ending issuance of bonds, and also de-dollarization and moves away from, by nations to diversify out of the US dollar financial system. I think that's going to really get some traction in the next couple of years. And this is all going to put the US dollar under pressure. So, the flip side of the US dollar being under pressure is that commodities, real assets, precious metals should all do really well in that environment, just as they did really well in the 1970s. And we might also see some of the emerging markets catch a bid. And I think, China, Hong Kong beginning to look really interesting from a contrarian's perspective, given that they're sort of probably nearing the end of what has been 2-year bear market cycles for those stock markets. Valuations are quite cheap. But of course, we need to really see that turning point and that inflection in the US dollar. And, we're not quite there yet technically in a near-term sense for the greenback.
Sure, and all this tension in the Middle East will not be the friend of the greenback at this stage, will it? It's probably just
the dollar typically catches a bid during times of geopolitical strife. But given everything that happened in the Middle East this week, I'm surprised that the US dollar wasn't higher. It ran out of momentum on the top side pretty quickly, and of course, those falling bond yields took the wind out of the dollar's sails this week. And I think bond yields are settling down into a new range. So just watching that US dollar quite closely.
Thought this was an interesting chart you ran today or just an interesting photograph. We talk about the Middle East tensions and everything that's going on over there at the moment. It seems to be very, very tense at the moment, and probably is going to become a lot more tense over the next couple of weeks. And history doesn't always repeat, but often it rhymes. And I know you ran this today in your daily.
It actually was yesterday. Look, it's remarkably uncanny in terms of what's happening today, in terms of bond yields moving up, inflation, geopolitical tensions on the rise, situation in Ukraine, and of course this week, the incursion into Israel by Hamas, and by Israel now getting ready for a major response, massing troops at the border, getting ready for what probably is an imminent ground invasion into Gaza. So it's all very sort of eerily familiar. I mean, one immediate question that we've got to ask ourselves is, with the US, handing over all this money and financing and funding the war in the Ukraine, how are they going to now fund the second one in the Middle East? They've already deployed 2 carrier groups to the Mediterranean. And of course, this whole conflict it's unfolding now in the Middle East. Not only is it likely to go on for some time, the US is going to be behind Israel, supporting them militarily and supplying them with military hardware. But, there's a risk that it escalates, and it becomes more of a regional conflict. So, something to watch. I think that in terms of some of our themes, such as gold, silver, precious metals, this is a sort of right sort of environment for them. Just as they did really well in the 70s, amidst a very similar sort of a backdrop, we're now beginning to see all of these factors converge and start to come together. And it's not history repeating, but it's certainly rhyming. We've got big spending by the US government on wars. We've got budget deficits, particularly big US budget deficits. We've got inflation in the background. We've got a wage price spiral. We've got industrial action. We've got central bank buying on a regular basis now in the precious metal markets. So, you know, if we're right on the US dollar, having another big leg down and really confirming a secular bear market, you know, over the coming year, then you'd think that the precious metals, Bitcoin, the cryptos are all going to be a lot higher this time in 12 months. So I think there's some opportunities there.
So let's start with silver. Let's have a look at this 10-year monthly chart on silver, and what are you seeing here?
I think this chart's really interesting. I mean, silver's lining up nicely. It's converging within a triangle range, you know, which are characterized by you know, contracting resistance and you know, rising support, converging to the apex of the triangle. You know, these are often patterns that are resolved with a powerful dynamic. And, you know, as we can see really with silver this week, you know, it got down to $21 when the US dollar was on a tear a couple of weeks ago, but it's had this decent upward dynamic back to 22 US dollars. And, you know, as we get closer to the apex, it's going to be easier for silver to stage a dynamic breakout. In fact, I think the resistance on the top sides, you know, sort of coming now and in the mid to high 23s with support around the 22 level. Now, I'm not too concerned about a breakdown because as we can see, silver formed a huge base between 2013 and 2020 before breaking out of that base. So, you know, silver will be strongly supported at 18, but it's very open-ended on the top side with immediate targets to $29. And, you know, and I think really the catalyst for a breakout in silver, gold, and certainly the cryptos, I think it's really going to be this whole sort of trend which is playing out, which will play out over a number of years now, with US fiscal spending being well ahead of what's sustainable. It's an election year next year. Both sides are unlikely to do much in terms of trimming spending on that front. And of course, rising geopolitical tensions and central bank buying. So yeah, look, the bullish, the technical setup for both gold and silver, I think, is really quite bullish. And you know, given that we've had these decent retracements in both silver and gold from the recent highs, I think, you know, this sort of sets up a nice buying opportunity. And, you know, I really believe that, you know, precious metals and precious metal equities warrant a position in, you know, investor portfolios. It's a good hedge, not just against inflation and the US dollar, but, you know, what's happening on the geopolitical stage.
Do you think gold may have found an important low here?
I think it has. You know, we need to see a breakout above sort of 1900 to really sort of mark a resumption of upward momentum, and you know, and providing a clear technical signal that spot prices are getting ready to have another run at the record highs above 2000. But you know, the way it's holding in there, it's holding in above that primary uptrend that's sort of been in place since 2018. It's very encouraging. And you know, we've seen some decent strength in the US dollar in the last year and a half, decent strength, and gold has actually done really well in a relative sense. You know, when the dollar index got up to 114, you know, we saw a pullback to 1600. This is well above, you know, the 1400 we saw it get down to during the pandemic sell-off. You know, in the recent run to 108, 109 on the dollar index, we saw gold pull up around 1800, just above 1800. So it's holding in there nicely. And of course, in local currencies around the world, it's near the all-time record highs. You know, Japanese yen, gold priced in Japanese yen, gold in euros, gold in Aussie dollars. I mean, it's doing well across a range of currencies. And of course, you know, local gold producers or precious metal producers in local currency are making good money and good margins. So yeah, I just really wanted to put the spotlight on what's happening there. It was really interesting that Paul Tudor Jones, you know, a legend in the hedge fund industry, you know, he's a lot older than me, but he made a lot of money out of the Wall Street crash in '87. He called the rally in the US stock market really well. He summed the markets up really well back in January of this year, and now he's turned bullish on gold and the cryptos, and you know, citing a lot of the reasons that I've been sort of talking about, you know, in the last several months.
So I thought we'd just look at this chart with Ethereum. It's risen in a consistent uptrend. Mm.
Yeah, Ethereum, I mean, they haven't fully inflected to the top side, but it's looking like Ethereum and Bitcoin are going to inflect. And you know, at 1500, we've got this sort of consistent sort of uptrend in place since the bottom at around 900 in 2022. And you know, I think the way Ethereum is tracking is we're going to see a retest of the resistance level at 2100. A breakout above that level and a successful retest of that level would then define an inflection and higher levels. So I think, you know, the bear market that we've seen in the cryptos is rapidly coming to an end. I think better days lie ahead for the cryptos. Very similar pattern to, this is actually Ethereum. It's not Bitcoin. But yeah, it's a similar pattern for Bitcoin.
Okay, Angus, I think we just go to a couple questions. I'm still getting some questions from members about your key themes at the moment. Still energy, healthcare, defensive, Japanese banks, and levels of cash. I just thought maybe you could just reiterate your view on the energy sector and the coal stocks at the moment.
Yeah, so look, just to unpack that question, in terms of, you know, strategy, look, I'm still advocating carrying to the 10 to 15% cash. Yeah, we did reduce our cash weighting like 3 or 4 months ago, but we're still carrying, you know, close to 15%, up to 15% cash across all our portfolios. I still think that's the best strategy. Certainly would not be advocating deploying leverage into the stock market at the moment to gain equity exposure. And if anything, you know, we've used a bit of hedging in recent months in the Global Contrarian Fund just to bring down our net exposure. I think, you know, one needs to be reasonably cautious in terms of what sectors we like and what I like at the moment. I still like I really like the precious metals. I think what we're seeing on the US fiscal side and rising geopolitical tensions this week, perfect backdrop for the precious metals to do really well in the year ahead. So we're obviously positioned there. I like the energy sector, you know, and by that I mean oil and gas. I still like the big major energy companies that are generating lots of free cash flow, defensive balance sheets. And I think, you know, the world's going to continue to need more oil. You know, there are supply constraints within that industry. There hasn't been a lot of exploration. The world's still going to use a lot of oil for the next, and gas, you know, for the next 10 years. That trend's not going to go away. And so, you know, there's upward pressure. And I think OPEC have got pricing power, given that, you know, we're not going to get the same sort of supply response as quickly from America as we did in previous cycles. So, you know, because of political issues, because of ESG issues, you know, the majors are not going to be able to, the industry is not going to be able to ramp up production like it has in the past. And, you know, so that puts, that gives OPEC a lot more pricing power. And of course, you know, watching the situation in the Middle East closely to see if Iran gets embroiled in the conflict. They're the third largest producer in OPEC. So I think there's upside price risks there. And of course, we're going into the northern hemisphere winter, where they consume a lot more energy. Still like uranium, we've seen a correction this week in the uranium stocks. I think it's just a correction. You know, members will know that, I've got sort of quite high convictions that the nuclear energy has to plug a gap. A lot of countries are going to have to turn to nuclear energy to shore up their baseload if they want to achieve green energy and zero emissions by 2050. I mean, climate change is necessitating that. So still like that. I'd still like the Japanese stock market. I think it's been one of the best performing markets this year, and I still think unlike the rest of the world, inflation's actually been good for Japan. It's shaken the economy out of decades of stagnation, and it's actually been a powerful positive force for the Japanese. And so still bullish on Japanese stocks and Japanese financials in particular. I think it's only a matter of time before the Bank of Japan lets the 10-year bond yield rise well above that 1% cap, and that has got to be really good for the Japanese banking sector. So still very much like that as a theme. And I think other stock markets outside the States are going to do better in a relative sense. I know we've been saying that for a while, but given the valuation of the UK, the ASX 200, Japan, China, Hong Kong, even, given those valuations, Europe are a lot lower. It's fair to say that there's less downside risks. So, advocating, overweight investment outside the US, and I'm still sort of avoiding the tech stocks. I think the time to buy those is not yet. I think we've just got to wait for the opportunity, wait for the fat pitch, and I certainly wouldn't be buying those richly priced US tech stocks at present. I also think that Hong Kong and China are looking really interesting from a contrarian's perspective. 2 years into a bear market, it's nearing an end. Those markets are no longer going down on bad news. Technically, we're yet to see confirmation that those bear markets have ended, but I think we're getting closer. A weaker US dollar would certainly help the emerging markets.
Getting questions on the best way to get exposure to the Japanese stock market. I know you've got quite a bit of coverage and positions in both of your funds at the moment, but what would you suggest to some of the members on probably the best and easiest way to get some exposure to Japanese banks and the Japanese stock market?
Look, ETFs are a good way. We've handpicked our stocks that we hold over there, but ETFs can be a good way of getting exposure. I think that I'm probably a little bit wary of some of the companies, the exporters that have done really well on the back of the cheap yen, and the dollar has rallied against the yen to the point where the Japanese currency is now really undervalued. So there's risk that there is risk that the yen actually has a resurgence next year, particularly if the Bank of Japan remove yield curve control measures. And so a little bit cautious towards some of the industrials. And I do prefer, some of the cheap financials. I quite like Inpex, which is the largest energy and gas producer. But look, generally, the story for Japan really is one of rising return on equity and better shareholder returns through through buybacks and higher dividends, etc., by the corporate sector, and I think that's going to continue. So probably an ETF or an index tracking fund might be the way to go for those that don't want to take on specific stock risk. It's probably a good time in terms of the currency, given that the Japanese yen is so low.
Getting some questions on the coal stocks and the dividends that they're paying at the moment. Do you think that'll they'll be able to sustain those high dividends at the moment?
A lot of it's going to come down to the coal price. My view is that the coal price has bottomed. Now, we did see a setback in coal last week, but that was caught up in a sell-off in the entire energy sector. You know, we saw the oil price come off $10 or $12. We saw $12 or so, 20 odd dollars in the coal price. We also saw, you know, the uranium prices come back a bit as well. So, you know, I just sort of see this as corrective, and you know, it's I think the coal, you know, we're seeing record amounts being imported by China, India, and I don't think that trend's going to slow down anytime soon. And I think that the coal stocks are pretty robust in terms of their cash flow. Some background noise there, Pat.
Well, I can't. Should be okay now. Okay, and Angus, I think that'll end. That's most of the questions that we've gotten. I thought we might just finish on the fact that you had a interesting trip and got to travel overseas. Were there any interesting things you took away from your time in Vietnam and the economy, or what you were seeing over there?
Yeah, I was intrigued to learn that Saigon's got more millionaires than just about any other country in Asia on a per capita basis. And, you know, the amount of development that had gone on in Vietnam since I was there last, which was sort of 7 or 8 years ago, was incredible, just in terms of the development. And, you know, I think what one of the big drivers behind the Vietnamese economy has been this reshaping of the global supply chain away from China, and Vietnam has been a beneficiary of that. You know, a lot of companies have moved their operations into Vietnam. The other interesting thing about it was it wasn't as cheap as what it was. You know, the currency had actually appreciated against the Australian dollar quite a bit. You know, over the last 7 years, it was no longer as cheap. In fact, I'm not going to say it was expensive, but it wasn't as cheap as what it was. So, you know, clearly that economy is thriving and doing quite well. And you know, we're sort of seeing that play out. It's interesting that the Vietnamese stock market hasn't really done that much, though. That's interesting. And, you know, I put that down to the fact that the US dollar has been quite strong, you know, in the last couple of years. That is really, you know, a headwind for emerging markets. You know, we've seen emerging markets, aside from India, we've seen a few of them sort of underperform in the face of that US dollar strength. But yeah, it was interesting. It's an economy that's going from strength to strength.
Okay, well, it's good to have you back, and we'd like to thank all the members for joining us today. We hope you found the presentation today beneficial, and we look forward to catching up with everybody again in 2 weeks' time. Thank you, and have a good day.
Thanks, Pat.